Welcome to another episode of Equity Mates here at AusBiz. It is Wednesday, which means Watchlist Wednesday. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Great to be back for another Watchlist Wednesday, our favourite time of the week.
Absolutely.
We get to sit back, relax, and hear about 3 stocks on an expert's watch list.
Well, let's crack in. It is our absolute pleasure to welcome to the Equity Mates on AusBiz TV show, Ben Clark from TMS Capital. Ben, welcome.
Thanks for having me, guys. Love your content.
Thank you. So we're looking forward to this one. We've got 3 stocks on your watch list, but firstly, for those in the Equity Mates and AusBiz community who haven't come across Ben before, he's portfolio manager at TMS Capital, a boutique private wealth advisory firm, and has 20 years experience in markets. So really looking forward to this one. A couple of stocks that we are aware of and a couple of new ones, or one new one as well. So let's start from the top. MFG is the first one you have there, Ben. Magellan, one that is obviously very well known and is getting a lot of chat in our group at the moment. So keen to hear your thoughts. Why is it on your watch list?
Well, I think, fund managers can be quite cyclical businesses to own, and they can be ones that you can probably be, we generally like to buy high quality businesses and hold on to them for long periods of time. But with these businesses, they can definitely go through periods where markets, I think, sort of overly fall in love with them and then maybe get a bit downbeat on them. And Magellan's a business we've been tracking actually since 2006 when it first floated. It's probably one of the worst investment decisions I ever made was after buying in, I think at about 60 cents or something, and then taking up a capital raising they did at 95. I think it was from memory at the time. It's probably too painful for me to get the details right and think back to it. But, then the GFC hit and, Hamish Douglas, sort of famously said we were literally opening envelopes, hoping there were some checks in them to invest. But we did come back into the business a few years later. And, particularly just watching the thematic of Australians starting to embrace international investing, sort of more significantly. We saw in front of our eyes every 6 months or every 3 months that Hamish was going and talking to rooms of financial planners. It started with, boardroom table, him and 10 planners from different organisations. And within 5 years, he was there was 500 or 600 having a 3-course lunch at hotels in the city, and they were booked out within days of them sending out the invite. So you could just see the traction that occurred. And of course, they had a great period of performance. So we owned the business. We sold out about 2 years ago when the stock hit $60, $61. And there was 2 reasons for that. The first was they had 2 incredible years of performance. And that, of course, meant that they also had 2 very nice years of performance fees. And the PE re-rated to about 28 times on those what we would say were, expanded earnings, maybe earnings that weren't particularly repeatable in every sort of year of the market. So that was our reason to get out. We felt pretty good about it straight after. Magellan actually did a small capital raising at the time to start funding the off-balance sheets investments that they've moved into. And then it went straight into the 70s and we weren't feeling quite so good about it. But of course, what we've seen since then, it got hit during COVID, recovered. And in the last 12 months, there's been 2 things have occurred. The first is they've had a pretty average period of performance. It's been well written about, but certainly there's been very little in performance fees paid to the management business in the last year or even 18 months. And secondly, they've been pumping a significant amount of money, particularly into Barrenjoey, which is this kind of startup investment bank that they've put together and funded over $100 million of startup costs. So, and then if you look at valuation, it's now trading on about 19 or 20 times forward consensus. So to us, like, the earnings have gone from elevated to, we think, depressed, because we think Barrenjoey, just the people that they've got involved in this business, I just think it's inevitable that it will work well. It's just a matter of how quickly do those losses drop off and does it start earning a profit? I've got no doubt that Magellan at some stage will hit a decent period of performance once again. Performance fees will start flowing, and then I think the market will start coming back to the business.
Yeah, it's a fascinating story playing out. We've seen a lot of the investment banks downgrade Magellan, perhaps because of the whole Barrenjoey tension. But we'll see. But anyway, we'll move on. We could talk Magellan all day, but the next stock on your watch list is Pexa Group, ASX ticker PXA. So can you tell us a little bit about the company and why it's on your watch list?
Yeah, so this was one of the newest floats, one of the biggest floats that we've had in recent times. Pexa was probably one of the best deals I have seen Macquarie put together, where they basically brought together the land titles offices of each of the states, the 4 big banks, and the various state governments, and said, the way that we are settling properties is so antiquated. And if anyone's gone through a property purchase or sale, they'll know, it's just bizarre how even a year or two it used to be done. Multiple checks. If one party turned up and there was a typo on one of the check, the whole thing fell over, et cetera, et cetera, et cetera. So what they did was they established Pexa. They gave equity to all of the various players to bring them on board and to speed up the digitization of physical property settlements. And it's just one of these beautiful things where it was like a win-win-win. Like the equity that was given to the various parties made them a lot of money. Consumers ended up getting a much better experience and a much cheaper experience. Rather than paying $300 to do a land title search, if you're thinking of buying a place, it's now like $50. But for Pexa, it's still like a 99.5% margin that they're making on that. And so there's been a lot of shuffling of the deck chairs of the owners of this business. The banks have all cashed in, except for CBA. State governments have cashed in. And there's and then Morgan Stanley, Infrastructure, CBA, and Link are the 3 remaining shareholders. And there was a small free float that was listed onto the market. With the shuffling of the deck chairs, there was a lot of question marks from the analysts about whether the valuations that this business was being revalued at in private hands was actually warranted. But I think we've seen some time now of this business trading on the market, and to me, the market has ratified the valuation of the three parties. The next step for Pexa is there's a lot of operating leverage in this business, which is really now starting to be squeezed out. And just on its own rights, I think there's a huge amount of growth in front of this company. Like the property market, I think REA and Pexa could be 2 of the best ways that you could play it. There is some uncertainty about that what they're wanting to do is move into the UK and effectively do the same thing that they've done here. There's going to be costs sunk involved in doing that. There's question marks about the success. We think they've got a pretty good chance. We think they've got a good board, and if it's not looking like it's going well, they will pull back. But on its own measures, I really think that it's little talked about, but could be one of the best, sort of tech businesses that you can look at locally.
Yeah, that's really fascinating. I'm going to keep an eye on that one, but we do have to move on, Ben, and to close out a stock that we've spoken about here at Equity Mates before, and that is Endeveor Group. The ticker is EDV. We know it's recently demerged from Woolies, so what's the thesis with this one?
Well, I think that the opening thesis is that if you just went and bought every company that has been demerged out of another company, like the smaller part of it that's been demerged, I think the track record over the last 50 years on the ASX is like 81% of them have gone on to outperform the broader market. So, there's a big tick there in that, you're very likely to be onto something that's successful. And when you think about why this theme has occurred, like why have demerged businesses gone on to be so good? It makes sense, like if Bruce Matheson is the largest shareholder here. So, big tick from us. It's a founder-led business. The founder has got a huge amount of equity in the game. Bruce Matheson would widely be seen as probably the best hotel operator in this country. He owns 40% plus of the equity, so very heavily invested in it, and has taken an exec chairman, so involved in the business. It was interesting to us reading, listening to his comments leading into this demerger, where Endeavour was a joint venture between Matheson and Woolies. And his view was that Woolies knew that this business was going to be demerged some years ago. Woolies is, I think, stripping the business out because it doesn't want the poker machine exposure. It doesn't want the liquor. It can borrow money these days much cheaper through the green bond market if it doesn't have these nastier parts of the business. And it opens itself up to more potential investors who for ESG reasons wouldn't go near Woolworths. So for Woolworths, there's sense, but there also wasn't a lot of sense in investing any more money in these assets because it knew it was soon going to offload them. And Matheson's, spoken about the fact that he feels, that his hands were somewhat tied, that decisions he wanted to do couldn't do. And he spoke about, now the freedom and the ability to go out and run this business how he wants it run. And that's why I think you see demerged companies often do so much better, because it's kind of like the little bit of the carcass that, is not that pretty and maybe unloved. And so no capital's going into it. It's going to the sexier parts of the business or the higher growth parts of the business. Doesn't mean this can't be good. Now, the share price has come off since the demerger because, of course, a lot of the pubs and clubs that Endeavour owns are closed with the lockdown. Dan Murphy's, however, which is owned, is booming, and we all know that. And BWS, much inferior business to Dan Murphy's, isn't doing well. So there's a bit of a reopen trade here, but I think if you're taking a longer term view, founder, demerger, these are really good assets. They're really rare. And when you've got a good operator running them, I think you set yourself up for success.
On the Endeavour Group, I guess, you have to think about pokies and the potential regulatory risk that comes with pokies. It seems like depending on who's in government in different states, every now and then there's a bit of noise around, different forms of regulations to limit access to pokies or the amount of money that can go through pokies. How do you think about something like that, where there's this sort of like uncertain regulatory risk that may or may not impact a business? How does that sort of factor into your thinking about a potential investment?
Yeah, that's probably one of the $1 million questions with this company. I just think when you look at the history in Australia, there's been these concerns for many years. The reality is that a lot of the clubs out there live off the poker machine revenue. It's this bizarre sort of dichotomy where members are effectively funding the livelihoods of many clubs around the country. Look, it's an issue, but I think it's something that, to me, there isn't a near-term threat that there's going to be, there's been no flags that there's going to be some great regulatory changes. I think the changes in the landscape are going to be more incremental, where pokies are going to go cashless. There's going to be limits set on what you can bet, et cetera, et cetera. But you got to remember, like if you look at Justin Hemmy's organisation, Merivale, one of his formulas for success is that when he goes into, when he purchases new premises, he actually goes and rips out the pokies, sells them to other pubs and clubs and rejuvenates them. It's not like these assets without pokies are going to be dinosaurs. I think, personally, I think the immediate sort of maybe next 3 to 5 years risks of poker machines are probably not that high. There is a political nature to this ultimately. And maybe it's just that the pokies will provide slightly less revenue, but it doesn't mean, when you hear Matheson talking about these assets, they are giving that there are no more licenses for pubs being given out. There's a set supply of hotels. And it really is about running those hotels as hard as possible. And maybe in some areas it will mean pokies in the future make up less revenue, but it doesn't mean that the assets can't rise in value.
Love it, Ben. Well, 3 really interesting stocks to put on the watch list, and I'm sure a lot of the Equity Mates community would have taken a lot of value from that. Just a reminder there, we had Magellan, MFG, Pexa Group, PXA, and Endeavour, EDV. So it was an absolute pleasure having you on, and we look forward to getting you back at some point.
Thanks, guys. Appreciate it.
And that brings us to the end of Watchlist Wednesday here at Equity Mates. Hopefully you did take something out of that. Plenty of coverage of a couple of stocks that we've spoken about on the show before. If you'd like more information on what we're doing, head to equitymates.com. Otherwise, Ren, tomorrow we're closing out with a convo around. I can't even remember what we have.
I can't remember either, so you'll have to tune in tomorrow and be surprised with what we bring you.